Today I have to say congratulations Australia. A free trade agreement between Great Britain and Australia came into force a few months ago. The first duty-free shipment of Australian raw sugar has now arrived in the UK. Raw sugar from Australia has not been available to the UK without a tariff for 50 years. Last week, the first duty-free delivery of 33,000 tonnes arrived in London from food producer Tate and Lyle. According to the Australian Department of Agriculture, the DAFF, the British tariff for Australian sugar before Brexit was £350 or €408 per tonne. The UK-Australia Free Trade Agreement came into force on May 31st. As the DAFF informs, a duty-free sugar quota of 80,000 tonnes of raw sugar is planned for the first year. It will rise to 220,000 tonnes by 2030 and will then be abolished. The Free Trade Agreement was concluded under former Prime Minister Boris Johnson and former Prime Minister Scott Morrison. The Australian side pointed out the high animal welfare standards in Australia with regard to its animal export products. However, in Britain, farmers feared that imported lamb and beef would create an oversupply. That is why the Free Trade Agreement sets an upper limit for agricultural products for the first 15 years. From the perspective of Australia's Trade Minister Don Farrell, the trade agreement gives Australian agricultural exporters access to the British market that has not existed since the United Kingdom joined the European Economic Community in 1973. The UK sugar processing sector, food producers and consumers could now benefit from a greater supply of high-quality, sustainably produced Australian raw cane sugar at competitive prices. Agriculture Minister Mary Watt described the start of sugar exports as a great success and benefit for Australian agriculture, particularly for growers in Queensland. The Australian Office for Agriculture and Natural Resources, the ABARIS, forecasts an increase in total sugar exports for the current 23-24 marketing year compared to the previous season by 300,000 tonnes or 10% to 3.3 million tonnes of raw sugar equivalent. So Australia can be happy about the latest news, but Great Britain cannot at the moment that much, because the labour market in Great Britain appears to be increasingly weakening. In July, the unemployment rate was 4.3%, as the ONS Statistics Office announced on Tuesday in London. That was 0.1 percentage points more than the month before. In the 3-month average up to July, unemployment even rose by 0.5 percentage points. Other indicators also point to an increasing slowdown. The employment rate fell by 0.5 percentage points to 75.5% in the 3 months to July, and full-time positions in particular were affected, as the ONS explained. The number of job vacancies continued to decline and fell below 1 million. The trend has been declining for over a year. The labour market is beginning to feel the burden of the economic slowdown as the UK economy faces headwinds. That was said by KPMG economist Giles Selvin. At the same time, inflation remains high, higher than in any other G7 country. In July, it was 6.8%. And wages and salaries are still rising rapidly, which is giving the Bank of England a headache given the high inflation. Wages without bonuses rose by 7.8% in a 3-month comparison. This is the highest increase since records began in 2001. In real terms, that means taking high inflation into account, wages rose by 0.6%. In this calculation, salaries had been declining for a long time. In view of the ongoing risk of inflation due to strong wage growth, the signs in Great Britain continue to point to an interest rate increase. Basic salaries in the 3 months to July were 7.8% higher than a year ago. That's what the National Statistics Agency ONS said on Tuesday. Wage growth is therefore stronger than the increase in consumer prices. The inflation rate on the island fell to 6.8% in July from 7.8% in June. That's the lowest level since 2022. But the central bank's target inflation mark of 2.0% is still a long way away. The price data for August will not be available until Wednesday next week, one day before the next interest rate decision from the Bank of England is expected. From the perspective of its boss Andrew Bailey, the central bank is much closer to the interest rate peak after a series of monetary policy tightenings. However, with a view to the next meeting on September 21st, Bailey recently left it open whether things would go up even further. The Bank of England has decided on increases at all of its past 14 meetings and most recently raised the key interest rate to 5.25%. That's the highest level in 15 years. And strong wage growth is likely to prompt them to raise interest rates to 5.5% next week, according to most investors. The bigger question is the way forward, said BOE observer Hugh Gimbe of JP Morgan Asset Management. The central bank may be reluctant to tighten monetary policy further if it sees other central banks around the world taking a break. But if the situation on the inflation front does not improve fundamentally, a further increase to a key interest rate of 5.75% is certainly possible. And in this situation, Sir Tony Blair has urged Labour to stay in the middle due to the current situation and avoid tax and spend emerging from economic turmoil. The former Prime Minister also praised Sir Keir Starmer for bringing his party from the brink of extinction. But in an interview with the Financial Times, Sir Tony said Sir Keir would face a much more difficult situation than when he came to power in 1997. He said, "If Sir Keir Starmer wins the election, which I think he has a good chance of doing, he will be the 6th Prime Minister in 8 years. It's a chaotic country. We are not in a good shape." And he said it was absurd to criticize Sir Keir's policy offer as being in poor taste and that Labour should not equate being radical with just taxing and spending. He said the Conservative Party has raised and spent so much in taxes that we are in an economic crisis. Today's radical agenda is about understanding, harnessing, and exploiting the technological revolution. Everything else is secondary. The politician who led the Labour government from 1997 to 2007 told the newspaper that although he met Sir Keir quite often, he was his own person who had agility in the subsequent transformation of the party, and he has shown determination after the leadership of Jeremy Corbyn. And Sir Keir is openly seeking advice from Sir Tony and Gordon Brown about his possible entry into government. And the Labour Party has indeed announced a comprehensive program to combat inflation. I criticize them a lot, but I still want to mention that. Labour wants to reduce energy prices through government intervention. That means by nationalising energy companies or introducing a price cap. And Labour wants to increase consumer purchasing power by increased wages and benefits, although we heard in the beginning of the video about raising wages. And Labour wants to boost economic growth by investing in infrastructure and education to reduce unemployment and increase demands for goods and services. Labour has promised to introduce a price cap on energy bills, freezing prices at 2022 levels. And Labour has promised to increase the minimum wage again, and Labour has promised to invest 200 billion in infrastructure to boost economic growth. And Labour has promised to increase benefits by 10%. It is still unclear whether these measures will be enough to combat inflation in the UK and if they do them at all. But the current record inflation in the UK has brought a number of problems for the country. For example, inflation hits low-income households particularly hard because they have to spend a larger share of their income on essential goods and services. And this leads to worsening poverty. Inflation weakens economic performance by dampening demand for goods and services. This is because when consumers have to spend more on their basic needs, they have less money left for other expenses. The Bank of England has reportedly raised interest rates in recent months to combat inflation. However, this has also led to higher borrowing costs, which slows the economy. The UK government has taken a number of measures to combat inflation, including increasing taxes and reducing government spending. However, it is still unclear whether these measures will be enough to reduce inflation. And the prices of petrol and food have risen sharply. This has put a strain on households that rely on these goods. So inflation is a serious problem for Britain. It's still unclear how long it will be, or it will last, and what impact it will have on the country on the long term. But at the moment, it is still having an impact. And as I said earlier, it's still higher than in any other G7 country. And if you want to know more, the next video is right here in the end screen. I'll see you there. I'll be back.